ETFs versus mutual funds. The right tool and tax chips. So we're not talking about individual stocks. That's a deeper conversation. So we have two main types of investment baskets for this conversation: ETFs and mutual funds. Which one should you use as a beginner on Main Street? Hint, most 401ks or retirement funds for your workplace are set up in mutual funds. For everyday investors starting out, though, I strongly recommend ETFs. And here are some of the key reasons why they usually beat mutual funds. I mentioned the big F word earlier: fees, expense ratios. If you see that, that's fees, same thing. ETFs are typically passively managed, meaning that they just track an index. They have lower fees, often costing just a few dollars a year for tracking, I don't know, let's say $10,000 you have invested. Mutual funds are often actively managed by a team trying to beat the market, which is expensive, and those higher fees eat directly into your returns. Trading flexibility. You can buy ETFs at any time of the day. They usually trade at the same time stocks trade. But with mutual funds are only priced and traded once a day after the market closes. So usually around 4:30 every day, your mutual fund will trade based on the price of that trade at the day. So if you saw movement in an area inside of a mutual fund or specific stock, you could trade it your ETF at that time, but you couldn't in the mutual fund. Minimums. Many mutual funds require a larger initial investment, sometimes $1,000 or more. You can start buying most ETFs with a single share or even a fractional share from anywhere $10, $20 to $50. And here's a big one that trips up most people and costs them real money. Just the consequence. In mutual funds, the fund managers often buy and sell stocks within the fund throughout the year to adjust their strategy. When you sell for a profit, this may require capital gains to be distributed to you or in some type of taxable action. Even if other people inside those funds sell them for gains, you can be hit with a tax bill. This means you can get the surprise tax bill, like I said, in December on your gains, even if the total value of your fund went down that year, even if you didn't sell anything yourself. This is a huge unnecessary value detractor. ETFs are structured much more tax efficiently, meaning you generally only realize and pay taxes when you personally decide to sell the funds for a profit down the line. And in this case, that's years down the line. For building wealth simply, efficiently, and tax smartly, ETFs are the winner for the everyday investor, beginning investor. We're keeping it simple, Sam. All right.